Hey, it's Mike at Cross Country Mortgage. It's Monday. It's Monday morning, October the 28th. It's time for your Monday morning mortgage update for this week. Hope you all had a great weekend. The weather's starting to cool off. I sparked up the jacuzzi over the weekend in anticipation of some rain this week. So really, fall's hitting the North State. It's kind of nice to see. So let's talk about what happened last week and what's going to happen this week. I always try to give you data so that if you're buying a house, if you're selling a house, if you're working with buyers and sellers, this data is going to help you make decisions. It's going to give you some perspective on what's going to move the market this week. And there's so much uncertainty in the market. We've seen it for a long time. I was at an event on Friday, talked to a lot of people in the real estate industry, and everybody's basically saying, boy, once the election's over with, everything's going to change. It's not going to change. I think what it's going to do is put us maybe at ease, maybe not at ease, but at least we know which path we're headed towards. And that's going to maybe tamper down this uncertainty, and now we can move forward. But rates aren't going to fall off a cliff or jump up after the election. Home prices aren't going to fall off a cliff or jump up after the election. Nothing's really going to change except maybe the mindset of everybody. So what happened last week and what's going to happen this week? Last week, we saw another week of money dumping out of the bond market and rates going up. And a lot of this is caused by the uncertainty. Nobody knows what's going to happen. So instead of putting the money in the bond market or the stock market, they're just pulling the money out of it. And when money comes out of that bond market, mortgage rates go up. Let's look at the chart. I want to show you just what we've seen over the last few weeks and a couple months. So since the beginning of October, we've just seen this downward trend in the bond market. And we know mortgage-backed securities are traded in the bond market, and that's where mortgage rates are determined. And when we see this downward trend, money's flowing out. So again, another 67-point basis sell-off. The week before that was 33. The week before that was over 80. I mean, we're approaching a 200 basis point sell-off really in the last month. And that means rates have gone up. And a lot of this, again, is just caused by the uncertainty in the market and the fear of bond traders, the uncertainty of bond traders. They like to know what's happening. They like to know what's happening in the future. And there's so much different information that's affecting the market. Let's talk about that. What are we looking at this week? What's going to affect the market? So always try to give you 2, 3, 4 things. This week, we've got a big jobs week. A lot of jobs numbers are coming out. That's very, very impactful on the market. Inflation numbers coming out. A lot of different data. And all of this data is ahead of next week's next Fed meeting. Are they going to cut rates? Are they going to leave them flat? How much are they going to cut them? And everybody tries to get ahead of the curve on this, especially the bond traders, when they price out interest rates with the market, lenders, when they quote rates to borrowers. That mortgage-backed security market, it really is the main determining factor. So a ton of data this week. It is a monster week for data, and that monster week for data is the week before the Fed meeting next week. So jobs, let's talk about that. Every month, there's a week where a lot of jobs numbers come out, and we look at unemployment, payroll, jobless claims, hourly earnings, unemployment rate. Just every single day this week, there is a huge report or multiple reports that could move mortgage rates up or down or just do nothing. So we'll be paying attention to a lot of this every day, and this really causes a lot of volatility. The biggest thing that's happening right now, and it's been happening for a while, is we always get a private report from companies where they actually report their numbers, and then we get a government report that's a survey. It's just people call people. They do surveys with people that have jobs or don't have jobs and say, where are you at? So that's the government one. It's a survey. The private sector report that comes out on Jobs Week is data, real data. And the real data from the private sector has basically shown that we're in a weak economy, a weak jobs market. The BLS report that comes out on Friday, that's the survey from the government, says we're in a very strong economy, strong jobs market. It's conflicting, and nobody really believes this BLS report that comes out on Friday. I mean, they adjusted the number 800,000 jobs that they said were created last year, and then they said, oh, guess what? They weren't created. So their numbers, they don't have any reliability, but everybody looks at that BLS number for data. The Fed definitely uses that BLS number to impact their policy decisions. So what's the number going to look like this week? Are we going to see a strong jobs report or survey, or we're going to see a weak one. If we see a weak jobs survey, that's going to be very good for rates. If we see a strong one, it's going to be weak for rates. And bond traders always try to get ahead of this. And they bake in what they expect the Fed's going to do next week by looking at these numbers. But this report before the Fed meeting this week, nobody really knows what's going to happen. So there's a lot of volatility. So it's a very impactful week with these jobs numbers. Second thing is inflation. The number one report, the PCE that the Fed uses to determine what they're going to do with rates next week, is the PCE report. Is inflation going up? Is it coming down? Is it staying flat? The expectations the PCE report will be flat. That's actually positive for rates. We don't want to see it go above expectations. We want to see it flat or below expectations. That will be positive for mortgage rates. So we'll be paying a lot of attention to what that PCE report says this week. And then a lot of other stuff. So oil has been going up because of all the unrest in the Middle East. Well, Israel targeted some areas in Iran that they bombed. And actually, this was positive because they didn't go after oil refineries or anything else. And it appears that maybe Israel and Iran are not going to blow things up. Their cooler heads seem to be prevailing. Oil prices went down 6% just today, just this morning. So that's a big shift, and that's anti-inflationary. If oil goes up, oil prices go up, that's inflationary. So that could be a positive move for rates. Again, everybody wants to see if this is going to hold out this week. The rate decision from the Bank of Japan, what are they going to do with their Fed fund equivalent of Fed fund rate? That could really impact the market. GDP growth domestic product is estimated to be 3% this week. Now, nobody believes this. 3% is a roaring economy. This number, anything above 2.5, the bond traders don't like, which means it's bad for rates. So if this comes in at 2.5 or less, this is going to be positive rates. If it's a fake number over 3% or in that range, we'll see what the market does. And then Treasury selling a ton of debt. Is there going to be an appetite for this debt? That could move the market. So if we want to look at what's going to move rates lower, what is going to impact rates lower? Really three things. Will Israel and Iran do nothing this week? If they do nothing, that's good for oil prices. That means that rates will get better. If the PCE report is weaker or at the expectations, that's good for mortgage rates. And if we show signs of a weak labor market with all the jobs reports, that's good for rates. So we'll be watching those three things. If you have any questions, any insight on this report, please let me know. Give me some feedback. Report it. Send this to somebody who you think could benefit from it. Have a great week.